Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. And also make sure to check out the VIP Algos link below in the description.
Yeah, that link is a great resource if you're serious about the markets.
Definitely. So I want to jump right into this because the wealth building context today is basically centered around a looming crisis.
Yeah.
Think about this. Every time you type a prompt into an AI chatbot or ask it to generate an image, that single query takes up to 10 times more electricity than a normal internet search.
10 times. I mean, when you actually scale that out, it's wild.
Right. You multiply that by hundreds of millions of users every single day. We are staring down an energy deficit so massive, it honestly threatens to stall the entire artificial intelligence revolution.
It really is a critical choke point right now. The whole tech industry has kind of woken up to the fact that, you can build all the cutting-edge semiconductor chips in the world. But if you don't have the electricity to actually power the data centers housing them, well, those chips are just incredibly expensive paperweights.
Exactly. And that is exactly where Oklo steps in. They sit right at the intersection of that massive desperation for power.
They do. And the thing we really want to unpack for you today is this fascinating multi-billion-dollar paradox at the heart of their business.
Right, because when we look at the fundamentals, Oklo is completely pre-revenue. Zero sales.
Absolutely zero.
And they reported a net loss of $73.62 million for the fiscal year 2024. Their forward earnings per share is sitting at negative 88 cents.
Which is rough.
Yeah, I mean, to a casual observer, looking at a widening multi-million-dollar loss with absolutely zero top-line revenue, that sounds like a company in a total freefall.
It does sound like that, but that is where the context of heavy industrial engineering becomes so essential.
How so?
Well, you have to completely discard the typical Silicon Valley startup playbook here. We aren't looking at a software company building an app in a garage.
Right, where you can just ship a buggy beta version and patch it later.
Exactly. You cannot do a minimum viable product with advanced nuclear physics. The barriers to entry are first-of-a-kind construction, and they're operating in literally the most stringent, unforgiving regulatory environment on the planet.
So the cash burn is just the price of admission.
Basically, yeah. In the advanced nuclear sector, negative free cash flow isn't a symptom of a failing business. It's the absolute prerequisite just to exist.
Got it.
That $73 million loss, it represents heavy capital expenditure, massive research and development, and just the sheer cost of building out a public company infrastructure ahead of their 2027 commercialization target.
But here's the data point that completely flips the script for me. They are sitting on $2.5 billion in cash and marketable securities.
Yes, that is their trump card.
It's crazy. I look at that and think, it's kind of like funding the construction of a massive, futuristic city. You've secured all the billions you need to buy the steel, pour the concrete, and build the grid, but you just haven't collected a single dollar in rent yet.
That's a perfect way to look at it.
Well, my question is, how does this massive cash burn not completely terrify current investors? Why aren't we seeing massive equity dilution risk as they just try to keep the lights on?
Because that $2.5 billion war chest changes their entire leverage profile.
Okay, unpack that a bit.
Sure. So without that cash, a pre-revenue company trying to survive until a 2027 commercialization date would be forced into distress financing.
Meaning they'd be begging for money.
Exactly. They would have to constantly issue new shares at a steep discount just to fund their daily operations. And that relentlessly dilutes the value for existing shareholders.
Right, but because Oklo has this immense buffer, they don't have to do that.
Precisely. They actually have the runway to fund the first-of-a-kind construction of their commercial reactors, which they call Aurora powerhouses, by the way, without going to the market for a lifeline every single quarter.
I see. So the cash isn't just a safety net. It's a structural advantage that protects the equity.
That's exactly it.
But, money sitting in a bank account doesn't physically build a nuclear reactor. Competitors like NuScale and TerraPower, they also have significant backing. So how is Oklo actually deploying that capital to build a real defensible moat?
They're doing it through very aggressive vertical integration.
Oh, interesting.
Yeah. See, the traditional nuclear energy supply chain is highly fragmented. It is essentially this giant, incredibly fragile domino rally.
Right, lots of moving parts.
Tons. You have one company designing the reactor, then a completely different government entity handling the land, then a third party is manufacturing specialized valves, and a completely separate multinational corporation is enriching the fuel.
Sounds like a logistical nightmare.
It is, because if one of those dominoes falls, like if a custom valve manufacturer goes bankrupt or a fuel supplier faces a geopolitical embargo, the entire multi-billion-dollar project halts for years.
And Oklo is basically trying to build the entire domino rally inside a sealed room that they control themselves.
That's the goal. They aren't just handing off blueprints to contractors. They are actively securing their own regulatory licensing, they're sourcing their own fuel, and they're bringing the actual manufacturing hardware in-house.
So let's talk about the catalysts and the operational milestones here.
Yeah.
Because the mechanics of how they're doing this are fascinating. First off, they became the very first company to receive a site use permit from the U.S. Department of Energy for a commercial advanced fission plant.
Which is huge.
Yeah, that isn't just paperwork, right? That is physical land secured in Idaho to actually build and test on.
Right. But honestly, the supply chain maneuvers are where the real risk mitigation is happening, and that starts with the fuel.
Fuel certainty. I know this is a massive bottleneck for next-generation nuclear.
It's the single biggest bottleneck. Most of these advanced reactors, including Oklo's design, they don't use the standard 5% enriched uranium that legacy nuclear plants use.
Okay, so what do they use?
They require something called HAEU, that stands for high-assay low-enriched uranium.
Right, and for you listening, HALEU is uranium enriched to between 5 and 20%.
Oh.
And the physics of that higher enrichment are crucial because it allows the reactor core to be significantly smaller while operating for much longer periods without needing a refuel.
You get way more energy density.
Exactly.
Yeah.
But the problem is, the global supply chain for HALEU is incredibly constrained right now.
Which is exactly why Oklo went out and signed a direct letter of intent with Centrus Energy. Centrus is currently the only U.S. company licensed to actually produce HALEU. By locking in that supply early, Oklo is bypassing a bottleneck that could very easily starve out their competitors.
That's a huge catalyst. But they didn't stop at just buying new fuel, did they? They also formed a partnership with Standard Nuclear focused on fuel recycling.
Yes, and this touches on the specific design of their Aurora powerhouse. It is a fast reactor, meaning it uses fast neutrons to sustain the fission chain reaction. One of the really unique capabilities of fast reactors is that they can actually consume spent nuclear fuel, what we typically call nuclear waste, from older legacy thermal reactors.
Wait, really? So they can just burn the waste from old plants?
Essentially, yes. By partnering to recycle fuel and utilize surplus plutonium, they're tapping into an alternative fuel source that simultaneously solves an environmental waste problem.
That is brilliant. And the third major move they made was acquiring a company called AREC. We talked earlier about that fragile domino rally of third-party manufacturing. AREC is a precision manufacturing company.
Right.
So by bringing them entirely in-house, Oklo isn't waiting in line for some third-party contractor to machine a highly specific nuclear-grade titanium component. They just make it themselves.
Exactly. It gives them direct, hands-on control over their own production timeline.
I have to play devil's advocate for a second, though. I understand the logic of controlling your own destiny, but I look at this from a project management perspective. Biting off precision manufacturing, navigating HALEU fuel supply chains, pioneering fuel recycling, and trying to get a first-of-a-kind reactor design approved by the government, all at exactly the same time.
It's a lot.
It sounds like a massive execution hazard.
Yeah.
I mean, are they trying to do way too much, way too fast?
It is undeniably an execution hazard. Managing all of those verticals simultaneously requires flawless operational discipline.
Yeah.
But here's the thing. In the advanced nuclear industry, relying on external, unproven supply chains is widely considered to be an even bigger hazard. It is literally an existential threat.
Right, because you have zero control.
Exactly. If a third-party HALEU enrichment facility faces a 3-year delay, while Oklo's 2027 commercial target is destroyed, and there's absolutely nothing their management team could do about it.
That makes sense.
So by integrating vertically, yes, they take on more internal operational complexity, but they eliminate the external variables that historically cause these nuclear megaprojects to fail.
Okay, so we have the $2.5 billion war chest. We see the vertically integrated supply chain mode. Now we really need to look at the other side of the equation, the demand catalysts.
Oh, the buyers.
Because no one goes through this level of operational pain unless there is an unbelievable amount of money waiting at the finish line.
The macroeconomic demand driving this it's almost difficult to wrap your head around. Bank of America estimates that the global nuclear opportunity is sitting at roughly $10 trillion.
Yeah, 10 trillion. Yeah.
And parallel to that, McKinsey predicts that $7 trillion will be spent globally just on data center infrastructure alone.
Which brings us right back to that AI energy deficit we started with. Because data centers don't just need a lot of power. They need a very specific kind of power.
Right, baseload power.
Exactly. For you listening, think about how the power grid works. Wind and solar are fantastic, and they are totally critical to the energy transition. But they are intermittent. The wind stops blowing, the sun goes down.
You can't run complex AI models on intermittent power. Data centers cannot tolerate a drop in electricity.
They need baseload power electricity that is incredibly dense, ultra-reliable, and flowing 204/7 without interruption.
And historically, the only ways to get reliable baseload power were coal, natural gas, or massive legacy nuclear plants.
But the tech companies have aggressive carbon-neutral pledges, so coal and gas are out.
Exactly. And you obviously can't easily build a massive 1980s-style nuclear plant right next to a modern data center in the suburbs.
No.
But Oklo's smaller advanced reactors are designed to sit directly behind the meter. That means they can provide dedicated, localized, carbon-free power right on the data center's campus.
Bypassing the vulnerabilities of the public electrical grid entirely.
Yes. And the hyperscalers, these massive tech monopolies, they are recognizing this. They are no longer just leasing cloud space. They are essentially pre-ordering custom nuclear power plants.
It's wild. Oklo currently has a pipeline of over 14 gigawatts under non-binding letters of intent. And just to put a gigawatt into perspective for our listeners, a single gigawatt is roughly enough to power a medium-sized city of several 100,000 homes.
It's huge. A 14-gigawatt pipeline is immense. But, the market really only cares about binding commitment.
Which they actually have. They secured a binding 1.2 gigawatt power agreement with Meta.
And that is a phenomenal vote of confidence. When a company the size of Meta commits to a binding agreement of that scale, it signals to the rest of the industry that Oklo's technology has passed incredibly rigorous corporate due diligence.
They also have a 12-gigawatt partnership with Switch, which is a major data center operator.
Yeah.
And the momentum really doesn't seem to be slowing down at all.
No, there are persistent indicators of additional tech partnerships forming. And a really significant driver of this industry-wide attention is the fact that OpenAI's Sam Altman has a very long historical involvement with Oklo.
Yeah, we have to talk about the Sam Altman factor.
The signaling effect of that just cannot be overstated. When the architect of the generative AI boom is deeply invested in your specific advanced nuclear technology, the entire hyperscaler ecosystem pays very close attention.
Because the tech giants know their growth is entirely constrained by power availability.
Right. So Oklo's challenge now is simply converting the rest of that massive 14-gigawatt pipeline from non-binding letters into firm, binding offtake agreements as they get closer to that 2027 deployment window.
Okay, so if the story is this incredibly bullish, I mean, they have the cash, they have the vertically integrated supply chain, and tech giants like Meta are literally lining up to buy gigawatts of power. Why is the stock chart such a bloodbath?
The technicals are definitely telling a different story.
Looking at the sentiment and the technical data, Oklo is currently trading 54% off its peak. The narrative is pointing to the moon, but the market reality is pointing straight down.
What you are seeing there is the violent transition from a speculative hype cycle into an actual execution phase.
Okay.
Yeah, when Oklo first hit the public markets, it was swept up in the absolute euphoria surrounding anything related to artificial intelligence and clean energy. The stock just skyrocketed. But that 54% drop indicates a very painful consolidation. The weak hands, the highly speculative retail money just looking for a quick flip, they are being washed out.
And adding to that anxiety, we saw a cluster of insider selling occurring right near that $65 to $70 peak.
We did.
Now, to be fair and precise here, these transactions were executed via pre-arranged 10b5-1 plans. For context, a 10b5-1 plan is a legal mechanism where corporate insiders set up an automated schedule to sell a predetermined number of shares at a specific time in the future.
Right, it's totally standard.
Yeah, it's designed to prevent insider trading accusations, which means they scheduled these sales long before the stock actually peaked. But human psychology is what it is. Seeing executives sell at the top makes retail investors incredibly nervous.
It absolutely invites skepticism, but you have to weigh that retail panic against institutional behavior. Because while retail investors might be freaking out, short interest, which is the total number of shares sold short by investors betting the stock will fall, is actually dropping.
Interesting. So the professional bears are closing out their bets against the company.
Yes, it suggests that as Oklo slowly de-risks their operations, betting against their survival is becoming a much riskier proposition. We are moving out of that volatile hype phase and into an accumulation phase.
Where institutional money slowly buys in based on real, tangible milestones.
Exactly.
But the Wall Street sentiment is still completely fractured on what this company is actually worth.
Oh, the analysts are all over the place.
They really are. UBS recently maintained a neutral rating and aggressively lowered their price target to $55. Yet on the other end of the spectrum, Canaccord Genuity reiterated a buy with a target of $125.
That's a massive spread.
And Wedbush is holding at 110, while 2047 Wall Street issued a target of 95.63. The disparity is just huge. Why is the broader market treating a company with a binding meta contract and $2.5 billion in cash with such a severe wait-and-see attitude?
Because the market ruthlessly prices in the time value of risk.
Right.
A binding agreement for 1.2 gigawatts of power is technically worthless if you can't actually turn the reactor on. The market believes the demand is real. They believe the cash is real. What they're waiting to see is if Oklo can actually navigate the dense bureaucratic thicket of government regulation and physical construction without delaying past 2027.
Which actually brings up a very specific piece of recent market action. We saw a sudden 4% jump in the stock immediately following the news of the Centrus fuel deal.
And that perfectly answers your question. That 4% jump shows that the market is hypersensitive to fundamental execution.
They want proof?
Exactly. It proves the market is transitioning to a show-me-the-progress mentality. When Oklo successfully secured that specialized HALEU fuel, mitigating a massive supply chain risk, the market instantly rewarded them for it.
Which means we need to take a very sober look at the risks that could cause the market to punish them. What is the actual bear case here? What breaks this entire thesis?
The bear case is rooted almost entirely in construction physics and federal red tape.
Okay.
The primary tail risks are severe construction cost overruns. Building a first-of-a-kind advanced nuclear reactor is notoriously difficult. Engineering models don't always translate perfectly to physical reality, and when they don't, budgets just explode.
And if they overrun the budget, that $2.5 billion buffer starts to evaporate rapidly.
Very rapidly.
To cover the shortfall, they would be forced right back into that distress financing we talked about earlier, issuing millions of new shares at a steep discount, deeply diluting the value for anyone holding the stock right now.
Exactly. But the true existential threat, the thing that could permanently break the financial models, is a licensing delay from the Nuclear Regulatory Commission.
The NRC.
Right. The NRC is tasked with ensuring public safety, and they move at a notoriously methodical pace. If regulatory hurdles push that commercialization date from 2027 into, say, 2030 or beyond, the thesis collapses.
Yeah, that makes sense.
There is also the lingering risk that, despite the Centrus agreement, actual physical access to HALEU fuel could face disruption due to broader geopolitical constraints on uranium enrichment.
Look, this isn't a tech company pushing a software patch over the weekend to fix a glitch. This is nuclear physics. If you get it wrong, the consequences are catastrophic, which is why the government red tape is so thick. So realistically, if they face a multi-year regulatory delay, is that $2.5 billion enough to keep them alive?
If a delay stretches for a decade, survival is highly unlikely. The cash burn of maintaining the engineering teams and regulatory compliance would eventually drain the war chest. However, we do have to contextualize that risk with some recent, unprecedented regulatory momentum.
Right, the regulatory speedrun they just pulled off. Let's explain what actually happened there, because it is wild. Oklo recently received their PDSA approval.
Yes.
PDSA stands for Preliminary Documented Safety Analysis. It is essentially this massive, complex engineering proof submitted to the Department of Energy demonstrating that even in a worst-case scenario, the reactor design will keep the public safe. Getting that approved is a massive hurdle.
And right alongside that, they received accelerated approval of their principal design criteria from the NRC.
What does that mean in practical terms?
That means the federal regulator fundamentally agrees with the architectural and safety framework Oklo is using to build the reactor.
Okay, wow. And on top of those two, they were officially selected for the Department of Energy's plutonium program, which heavily validates their fuel recycling strategy.
The crucial detail here, though, is the timeline. All three of those massive regulatory green lights occurred within a tight 5-week window.
5 weeks.
Yeah. In the nuclear sector, a 5-week turnaround for that level of federal approval is almost completely unheard of. It suggests a level of rapid, active engagement from government agencies that is actively de-risking the project. The regulators are working with them, not just letting the applications languish in a filing cabinet for years.
So, synthesizing everything we've covered today, the $2.5 billion cash buffer, the vertically integrated supply chain, the staggering demand from hyperscalers like Meta, the painful stock consolidation, and the very real execution risks. What is the final verdict on Oklo?
When you look at all the factors, we are giving it a bullish score of 7 out of 10.
7 out of 10, okay.
Yeah, it is the definition of a high-risk, asymmetric upside play.
And what's our long-term view here?
This is absolutely not a short-term trade. It is a multi-year outlook heavily tethered to their ability to successfully turn a reactor on in that 2027 to 2028 commercialization window.
It sounds like it's specifically for the investor who intimately understands the difference between a software startup and a heavy industrial project, and who is willing to weather intense short-term volatility in exchange for a grand floor piece of the AI-driven nuclear future.
Precisely. The upside potential is directly correlated to the parabolic growth of global artificial intelligence. If you believe the energy demands of AI are only going to grow, and you believe Oklo's management can execute their vertical integration without catastrophic delays, well, the current valuation reflects a massive discount based purely on the fear of the unknown.
Remember, if you find our talks useful, please consider subscribe, like, and comment underneath. And be sure to check out the VIP Algos link below in the description to help you navigate these kinds of volatile setups.
It's a great tool. Highly recommend checking it out.
I want to leave you with a final lingering thought to explore on your own. We started today by looking at the strange paradox of a pre-revenue company holding the keys to the future of technology. We are watching tech giants like Meta and others aggressively race to lock in gigawatts of their own private advanced nuclear power as they secure their own independent energy grids, completely bypassing public infrastructure. Are we quietly watching the world's biggest social media and AI companies evolve into the sovereign energy utilities of the 21st century?
That is a profound shift in global infrastructure. It raises a fascinating question about who will truly hold the power, both electrical and geopolitical, in the next decade.
It really does. It changes the entire landscape. Thanks for joining us today on Smart Wealth with Joshua.